The fund company QYLG offers ETFs that, and I quote here, look beyond traditional fixed income, offering solutions for investors seeking to increase or diversify the yield potential of their portfolio. One well-known income generation strategy is to sell covered calls. QYLG offers 5 ETFs based on covered calls, and they're shown here. You are probably familiar with the one at the top. QYLD, based on the NASDAQ 100 index, has become a major player in ETFs over the past few years. All 5 of these ETFs from QYLG offer investors a simple way to participate in the covered call income generation strategy. The investor just owns the ETF does the rest. The big attraction to these ETFs is their income return. These ETFs have provided yields up to 12% over the past year to investors that own them. A secondary attraction for some investors is their monthly dividends. Each one of these distributes monthly to its shareholders. The purpose of this video is to describe and compare all 5 of QYLG's ETFs that use the covered call strategy. First, let's make sure that we're all clear on how covered calls generate income. Covered calls in the investment world are a form of the investment tool called options. Options are bets on the volatility of a stock price or of an index price. When option contracts are sold, neither the buyer nor the seller really knows what the volatility of the underlying security is going to be. That's why I call them bets. This display shows you QYLG's covered calls. They use the same system for each of the 5 ETFs that we're going to discuss today. Column number 1, what a call option conveys. A call option conveys the right to buy from the option seller an underlying security at what is called the strike price. In column 2, the call writer, which in this case is the ETF, sells the option, receives a premium for selling that contract, and the call writer or seller keeps the premium no matter what happens. Column 3, the call buyer, which can be any other counterparty in the market, pays the premium, and they pay that in order to get the right that's conferred by the option contract. Column 4, the term of the covered calls that QYLG's ETFs write is always a month. And since QYLG sells covered calls on indexes, those options cannot be exercised during the month. So as the price of the underlying index varies, if it exceeds the strike price in the middle of the month, that doesn't matter. All that matters is where the price is at the end of the month. Column 5, if the strike price is hit, that means that the buyer will exercise the option. The calls that QYLG sells are settled in cash. Shares do not change hands. The ETF simply pays up to the call buyers how much it owes for the strike price having been exceeded. And in column 6, if the strike price is not hit, the option is not exercised, the ETF keeps all the money that it received in premiums, and the options expire worthless, that's the term used, without being exercised. Now let's focus on the main driver of what's going on which is whether the strike price is hit. This slide shows in picture form what I was just talking about. There are 3 possibilities once a call option is sold. Number 1, the index might go down, and the picture shows the index price being below the red line, which is the strike price, at the end of the month. And in that case, the option is not exercised, and the fund does not owe cash to the counterparty that bought the option. The middle picture shows the index being flat, meaning that the index price is exactly at the strike price at the end of the month, and the result is the same. The fund does not owe any cash to the call buyer. The bottom picture shows what happens if the index price ends the month higher than the strike price. In that case, the fund does owe cash to make up the difference between the strike price and the index's price to all of the option buyers at the end of the month. So the primary purpose of a covered call strategy is to generate income. They do this by forfeiting some of the upside in the underlying security in exchange for the premiums that they get by writing the calls. For that reason, all 5 of the ETFs that we're talking about in this video are classified as alternative income category by Morningstar. All 5 of them work in the same way. Number 1, the ETF buys securities. The ETF buys the securities in the underlying index, or it buys the index itself. Number 2, the ETF writes the options that we've been talking about. They write them monthly. They have a term of 1 month. They choose a strike price that is called at the money, which means it's either at or slightly above the value of the index at the moment they write the contract. Number 3, the ETF collects the premiums on the calls that they write. And number 4, the ETF makes distributions to its shareholders, which means that they send to shareholders like you or me some of the premium money that they collected for writing the options. And that's basically it. And by the way, I just want to add, there's nothing special about this. Anybody can do it. It's not the province of only Global X or of major players in the stock market. The ability to write options is available to all of us, and many investors do it as a way to generate extra income on their portfolio. Okay, since they all operate in the same general way, what differentiates the 5 ETFs? Why are there 5 of them? The reason is that there are 2 distinguishing features among the ETFs. Number 1, the underlying stock index, and number 2, what percentage of calls are written. Here are the 5 covered call funds that Global X offers. And this slide shows the distinguishing features that I just talked about. So the first one is QYLD, and that writes calls on the NASDAQ 100 index, and it writes against 100% of the assets that QYLD has. Fund number 2 is XYLD. The index there is the S&P 500, and again, 100% coverage of calls against that index. Fund number 3 is RYLD. The index here is the Russell 2000, which I'll talk about in a moment, and again, 100% covered calls are written against that index. ETF number 4 is QYLG. The underlying index is the NASDAQ 100, but now only 50% coverage of calls against the index. And the final ETF is XYLG. The index is the S&P 500, and 50% coverage of calls against that index are written by QYLG. And you can notice, I know the tickers of the indexes seem complex and jumbled at first, but there is a pattern here. The middle 2 letters are always YL. The letter Q at the beginning always indicates the NASDAQ 100. The letter X at the beginning always indicates the S&P 500. The letter R at the beginning always indicates the Russell 2000. And the final letter is important. If it's a D, that means 100% coverage of calls are written. And if it's a G, which stands for growth, it means that 50% of calls are being written. This slide shows the 5 ETFs that we're talking about, and I've used the convention of using a light green background where it's 100% coverage of the calls against the index, and a light orange background when the coverage is 50%. So the top 3 are the green ones that write against 3 different indexes but always cover them with 100% of calls. In column 3, the upside potential compared to the index is basically none between the ETF writing 100% of the calls and the underlying index. And in a little while, I'll explain why that is. Just keep in mind the general rule that when you write covered calls, you're inevitably forfeiting some upside of the underlying index. Column 4, however, for these 100%ers is that you're generating the most income you can because you're writing all the covered calls that you can. And in column 5, we talk about the downside potential of the ETF. For the 300% coverage ETFs, the downside potential is the most, and I'll explain how that works in a little while. Whereas for the 250% coverage ETFs, the downside potential is approximately half that of the underlying index. The bottom line on all this is that each 100% covered fund has little or no upside potential when the options are written at the money, which is how each of the Global X funds writes its options. At the money, again, means that the strike price is approximately the same as the actual index price at the time the option is written. Compared to a 50% covered strategy, however, the fully covered strategy will typically generate higher income because it is selling more options and collecting more premiums. The bottom two funds, QYLG and XYLG, cover 50% of the value of their stock holdings or their index holdings with options. Thus, they participate in more of the upside because half of the underlying don't have options sold against them. QYLG still holds them, so if their price goes up, QYLG and XYLG benefit from that. But they give up about half the income, obviously, because they've only written options against half of the stocks or indexes that they own. This display shows some detail about the three indexes that are used by QYLD in their 5 ETFs that we're talking about. The first is the NASDAQ 100 index, which any investor can buy, by the way, using the ETF called QQQ or one of several others. The NASDAQ 100 holds mostly tech stocks. It holds no financials. Its volatility, its price volatility is high. It tends to go up and down faster than the market as a whole. It's been the best performing index among these three anyway, and one of the best performing anywhere over the last several years, as you're all probably familiar, because of the tech stocks it holds. It's delivered 23.3% per year performance over the last 5 years, nearly that good performance over the last 10 years. The second index is the very familiar S&P 500, which any investor can buy directly through the ETF called SPY and many other ETFs that follow it. The S&P 500 is mostly large cap stocks. It's very diverse in terms of covering all sectors of the economy. Its volatility is what I'll call moderate, or possibly could be called standard. And in fact, the S&P 500 is the standard for measuring volatility in the market. If you hear somebody on TV or read that the market was highly volatile today, what they're talking about when they say the market is actually the S&P 500. So the S&P 500's volatility becomes a benchmark for the whole market. It holds many of the same stocks that are in the NASDAQ 100, so its performance has been very good over the last 5 and 10 years, almost 16% a year over the last 5 and almost 15% a year over the last 10. And finally, the Russell 2000 is probably the least familiar index to you. It holds small cap stocks, and it holds about around 2,000 of them, so it is also very diverse. It also has high volatility, and while small cap stocks is often called the size factor in investing, small caps overall generally outperform the market as a whole. That has not been true over the recent past. It has the lowest 5-year performance at 8.8% a year and 11% a year over the last 10 years. Volatility can be important because as price volatility rises, the price of options goes up. And I just want to show you the comparative volatility between the Russell 2000, the small cap index, and the S&P 500. This graph goes all the way back to 2004. The S&P 500 is shown in black, the Russell 2000 is shown in orange, and as you can see, the Russell 2000's volatility is almost always higher than the volatility of the market itself, or the S&P 500. Finally, there is one other point that I want to make. Usually when you hold an ETF, you are said to hold and get the benefit of the stocks in the fund. That is true with ETFs, and it's true with these covered call funds, but I want to repeat a caveat about these funds because they're using the covered call strategy. From your point of view, owning an ETF that's writing covered calls against the stocks in the fund carries a risk, which is actually a near certainty that potential benefits from rising prices in the underlying indexes will not accrue to your benefit. Remember, if the index's price is above the strike price at the end of the month, further price increases go to the option buyer, and Global X for each of these ETFs pays out that extra money in cash. Global X itself is very clear about this, and I will quote what they say. Covered call strategies inherently forfeit upside in exchange for current income. That's a very important point to keep in mind as we talk about all of these covered call ETFs from Global X. And they make no bones about it in their own literature. It is what happens. This display discusses what I've just been talking about. Global X's covered call funds do not present themselves as buy and hold investments designed to amass wealth. Rather, they do present themselves as sources of reliable, high yields that are paid monthly. And in the light orange section at the bottom of the display, the two that write covered calls against 50% of their holdings also present themselves as offering some upside potential in addition to the higher income. I want to show you this display for several reasons. It doesn't matter if you can read the exact numbers and scales. I'll tell you what the slide displays. These are the dividends paid out since the inception for each of the 5 covered call ETFs that we're talking about in this video. And they're in the same order that I've been presenting them. So QYLD is the first, the 300% coverage ETFs are the top 3, and the 2 that write only 50% coverage of their calls are the last 2. I want you to notice several things. Number 1 is just the length in history. QYLD is the second oldest among these. Its history goes back to the beginning of 2014. XYLD's history goes back about 6 months earlier than that. But RYLD was just introduced in 2019, so its history goes back a little under 3 years. And the bottom 2, which are the two 50% coverage ETFs, only started in 2020, so their history only goes back a little over a year. Another thing I want you to notice about these payouts, these monthly distributions, is that they're variable. Unlike many dividend growth stocks that we see, which pay out dividends 4 in a row at the same amount, raise it once, 4 in a row at the same amount, and so on, that's not how these operate. These are unmanaged, and they make no effort to equalize the dividends or smooth them out that they pay out each month. That's why you see all the jaggedness in the lines. This display talks about pros and cons of those variable monthly dividends. I call these negatives and positives because they do have that tilt, but they're also just facts that you should know when you're thinking about these ETFs. In the first row, the unpredictability of the monthly distributions will strike some investors as a disadvantage, but on the positive side, to my knowledge, none of the 5 ETFs has ever missed a monthly payment. So the variability never drops to 0, it simply hops around. In the middle row, because of the variability, you do not know the total payout for a year, a calendar year, until the last month of the year, and that may strike you as a negative. On the other hand, the overall yields, as we'll see in a little while when I show you yield charts for each one, the overall yields are pretty predictable within a range. Again, to me, that makes the variability from month to month easier to live with. And in the bottom row, again, to repeat a theme that I just want you to all to understand when you're thinking and talking about these, any covered call ETF forfeits most or some of the price upside that would be available to you if you owned the underlying index. The positive, of course, is that because of the covered call premiums that the ETF collects, the ETF generates much more income than the underlying index. This display shows Global X's covered call funds performance, and I know it's a complex table. If you wish, you can stop the video and study it. I'm going to address just a few highlights for you. First of all, the arrow down at the top of column 5 indicates that's how I've organized this table. So the table is organized in terms of the total assets that are in each ETF, and you can see that the largest ETF is QYLD at $6.1 billion. None of the others has yet reached even $1 billion. So QYLD so far has been the runaway winner in terms of accumulating assets from investors. Also regarding QYLD, in column number 4, the yield, notice that it has the highest yield among these, tied with RYLD 2 down at 11.3%. XYLD, the other green backgrounded 100% coverage ETF, also has a very high yield, currently at 9.1%. In the RYLD row, which is the third one down, I've highlighted several things. One is the launch date. Notice that this was only launched in April of 2019, so its history is much shorter than the top 2. It's accumulated $890 million in total assets, which means it's a fast grower. It is practically caught up to the one above it, XYLD, even though it is 6 years younger than XYLD. And in the column 6 and 7, I've highlighted the price return, but I've also highlighted the fact that even though the columns are labeled 5-year price returns, price only, and then again with dividends reinvested, that information only covers 3 years, not 5, because that's as long as the ETF has existed. And again, it makes the data somewhat unreliable, some would say unacceptable to even consider buying. And in the bottom two, I've highlighted that they're very young, both being launched in September of 2020. And again, over in the column 6 and 7, the 5-year annual returns, they're not really 5-year returns, they're returns for the life of the two funds, which in each case is only a little over a year. In working with these ETFs over the last few months, I've come to believe that a good way to consider the valuation of them is to use what's called the yield metric. And what the yield metric is, for those of you that may be unfamiliar with it, is to compare the fund's current yield to its 5-year average yield. The idea behind that is if the fund is yielding more right now than its 5-year average, it's probably undervalued and a good buy. And if it's yielding less than its 5-year average yield, it's probably a little overvalued and not a great time to buy it. You might as well wait until the yield goes above its 5-year average. Since we're going to use yield and the yield metric to value the indexes, or the ETFs rather, I just had to show you this. How are you going to figure out what the yield is? I went to several sources, all common ones that you might use in your own research, and what I discovered is that everybody's calculating the yield in a different fashion. So out of the 10 or so sources shown on this slide, the yield, which is labeled differently by each source, comes out to a different number each time. That is really unfortunate. There should be an industry standard for calculating the yield of an ETF, and apparently there's not. I'm not happy about that, but I will show you what I've done about it for the purposes of this video. Down at the bottom in the blue row, I calculated the current yield the way I think it should be calculated, which is to take the last 12 months actual dividend payouts, add them up, and divide by the current price of the ETF. Doing it that way, I get a current yield. I used QYLD as an example here. I get a current yield of QYLD of 12.7%. But as you scan up that column, the yield column, you won't find anybody else that got a current yield of 12.7%. At the bottom, I averaged out everybody's estimate or calculation and came out at 11.9%. So the answer is they're all hanging around in the 10, 11, 12% area, but it's very unfortunate for us as investors that all the sources differ from each other. These graphs, all from Y-chart, show you the yields back to inception of each of the 5 ETFs that we're talking about. A couple things to point out about what we're looking at. Number one is that the yields go up and down as two things happen. As new distributions come out, and because the distributions vary, that means that the total of the last 12 months or whatever they're taking to calculate the yield changes. Number two is that they vary. And number three, the length of the lines indicates the total history of each ETF. And again, a couple of them go all the way back to 2013 and 2014, but a couple of the other ones, the 250%ers shown at the bottom of this chart, only go back a little over a year. Now this chart shows you just one example of how I ended up calculating the yields for the purposes of doing valuations for this video. This one shows QYLD. It shows its full dividend history, yield history, but I've only gone back 5 years because, as I said, I used the 5-year average yield, and I simply eyeballed it. I don't think you have to be extremely precise in calculating what the average 5-year yield is. So I eyeballed it, and that's where I drew the yellow stripe on this graph at what I think is approximately the average yield of QYLD over the last 5 years. You may not be able to read the scale on this chart, but it comes in at just about 11%, and you can see that QYLD's current yield, which is shown in the purple line, is above that, meaning that I would consider right now a decent time to buy QYLD from a valuation standpoint. This display shows now my valuation estimates for each of the 5 ETFs that we're talking about. I'm using Y charts, and the reason I'm using Y charts is because at least we know they're using the same method for when they calculate yields, number one. And number two, I discovered in doing the research for this video that even if you don't subscribe to Y charts, you can get free images of the yield graphs by simply Googling, for example, QYLD yield. One of the results will be a free picture, a free sample of Y charts. So Y charts are available to all of you for free, and I think that's important, and that's one of the reasons I chose to use Y charts for all these valuations. Just quickly going down the center column here, I'm estimating valuation by using yield rather than price, so it's fair value for each ETF if it's above a certain yield. I won't read the numbers to you. You can see the top 3, which are the 100%ers, have fair values at higher yields, and the bottom 2, which are the 50%ers, have fair values at lower yields. And then in the right column, I put the actual yields right now, or the day before I recorded this video. They're all happen to be above what I think is the average 5-year yield, and so I put a check mark next to each one. I think that each one happens to be fairly or undervalued right now, and if you're considering any of the 5, now wouldn't be a bad time to purchase it. Okay guys, if you're still with me, thanks for listening to this video and looking at the displays. I hope it's helping you understand the various covered call ETFs that are available from the company Global X, as well as other covered call ETFs that you may be considering. And this final slide tries to summarize everything we've talked about. These are my takeaways and hope will be your takeaways from this video. Number 1, price returns are inversely related to yield. The higher yield, the lower the price returns that you can expect to get from the ETF, and vice versa. Number 2, yield is related to what percentage of covered calls are written. So an ETF that writes covered calls against 100% of the securities that it owns is going to offer a higher yield than one that writes covered calls against, say, 50% of the securities that it owns. In the case of Global X ETFs, the 100% writing of at-the-money covered calls tends to result in yields that are in the 10 to 12% range, and 50% calls tends to result in yields that are half that, 5 to 6% or so. Takeaway number 3, covered calls inherently forfeit price upside. I've said that probably 10 times in this video, and I want you all to understand that. That is the trade-off that you're making when you buy a covered call ETF. Point number 4, however, in return for forfeiting that upside, you get higher yield. The covered calls inherently produce more income than just the dividends that are being paid by the securities held by the ETF. And if you are retired and needing income, that can be very important to you. It may relieve you from needing to sell shares to finance your retirement life. Point number 5, they all pay monthly, and a sub-point to that, the payments vary from month to month for all 5 of these ETFs. Point number 6, kind of circling back to the point that I want you to all understand, you got to be comfortable with the trade-offs. Don't even consider these unless you are comfortable with the idea of trading total return for current or immediate income. That's why these exist. If that's not one of your goals, don't even think about these. And point number 7, the 2 most recently introduced ones, QYLG and XYLG, and those are the 2 that write 50% covered calls rather than 100%, so they end in the letter G and they offer some growth. In my opinion, they have too short histories to rely on. I would not purchase them yet. You may have noticed on the yield charts with some of the others with longer histories, the yields start off kind of low and then they go to a different level at which they've stayed ever since. QYLG and XYLG may be in that stage right now because they are so young, and I think it's just too soon to buy them. I usually don't buy anything either a company or an ETF or a fund of any kind that hasn't existed for at least 5 years. I like to see 5 years of history on anything I buy. Thanks for listening, guys. I hope this helped you all out. I'll see you soon, and goodbye.